Hello and welcome everyone. This is Professor Siddharth Surana. I hope you guys are doing good. और मैं तो हमेशा मस्त ही रहता हूँ. Welcome to episode number 2 of revision cum amendments in direct tax applicable for May 22 and November 22 exams, previous year 21-22, assessment year 22-23. In the first episode, we have finished our introduction class where we have tax rates. We have finished that. We also finished the double taxation relief and cash loans chapter. So moving ahead in the order of our book and from our handwritten book, Exemption 2.0. Next chapter number 4, taxation of NRIs. As you are aware, this is important because it is a part of international tax. Wherever we have non-resident, it is a part of international tax spread over section 115C to 115I. This is chapter 12A. Don't get confused. You should all remember chapter 12 is 110 to 115 BBG, special rates of tax, which is compulsory special rate of tax. But this chapter 12A, which starts after 12, that is 115C to I, this is optional. This is not going to be compulsory. This chapter is going to be optional. Okay. And this chapter 12 we will be covering in the very next chapter. Chapter 5 of our book, as you are aware, again is special rates of tax, where we will cover all this. But some of the sections from this range, like the capital gains part, will be covered in the NRI chapter itself. So for now, we will be learning the chapter NRI taxation. This chapter is applicable only to specific assessees, that is non-resident individuals. That means residents will not be covered here. This chapter covers only specific incomes. We all know there are two incomes, investment income and LTCG on forex asset. Investment income and LTCG on forex asset, only two incomes are covered here. Any other income of NRI will be taxable at normal rate. That means if you recollect, normal assessee normal income, normal rate. Normal assessee specific income, normal rate. Specific assessee normal income, normal rate. This chapter will apply only and only if it is specific assessee specific income. Specific assessee specific income, and that also is optional. That means even if the combo has taken place, we can still go for the normal rates of tax. So if the combo does not take place, normal, and if the combo takes place, normal rates or these special rates, out of the two, whichever is more beneficial to the assessee, because the provisions of this chapter are optional. They are giving you an option. Wherever you will find an option in income tax, you will definitely find this gentleman. He is giving an option. Before we start the actual chapter NRI taxation, in our class also, full course, crash course, everywhere, we first do a little discussion on capital gains. We also cover the residential status part in this chapter. This is that chapter where I cover residential status with CA final students, and then we actually start the main chapter. So very quickly, what is the capital gain part that we discuss for better understanding of this chapter? Capital gain is of two types, long-term capital gain and short-term capital gain. It depends on the type of asset. If the asset is long-term, gain will be long-term. If the asset is short-term, gain will be short-term. So if you are asked, when does capital gain become long-term? If asset is long-term. If asset is long-term, gain will be long-term. And now when does asset become long-term? Any asset will become long-term capital asset if it is held for more than 36 months, greater than. So equal to, again, not covered here. Less than and equal to will go in short term. Less than and equal to will go in short term. So what is the rule? Holding period greater than 36 months. So asset will become long term. Gain will also become long term. Holding period greater than 36 months. But some assets will become long term after 12 months. Listed securities, excluding units. Units will not be covered here. So when we talk about listed securities, what does it cover? Listed equity shares, listed preference shares, listed bonds, listed debentures, listed government securities. 12 months will apply. Because for units, we have second point. Units of UTI, units of equity oriented mutual fund. Listed, unlisted doesn't matter. So debt oriented mutual fund, money market mutual fund, all those units will go in 36 months. Only equity will come here and zero coupon bond. So three assets which will become long term after 12 months. Listed securities, units of equity or mutual fund, and zero coupon bond. And two assets will become long term after 24 months. Unlisted shares of a company. They mention shares means all types of unlisted shares covered, and immovable property, which will cover land, building, or both. So three assets will become long term after 12 months. Two assets will become long term after 24 months, and all other assets will become long term after 36 months. And remember, This is all greater than. So less than will go in short term and equal to will also go in short term. Less than and equal to will both go under short term. Then long term capital asset, if it is held for more than this period and therefore less than or equal to 12, 24 or 36 will make it short term capital asset. Now once our asset becomes long term, our gain will become long term, and once our gain becomes long term, what are the benefits that we will be eligible for? First tax benefit is going to be the benefit of indexation. Whenever an asset is long term and therefore your gain will be long term, the benefit of indexation will be available. That is, we will give inflation effect in the cost of acquisition. Sale minus cost is our capital gain, but if it is long term, we will inflate the cost, index the cost. That means if the cost will increase, the gain will reduce, and thus our tax liability will reduce. And how do you calculate index cost of acquisition? Cost of acquisition into cost inflation index of transfer year divided by cost inflation index of acquisition year. COA into CII of transfer year divided by CII of acquisition year, where CII refers to cost inflation index, which is issued every year by way of notification for this purpose. Base year taken by the government is 0102, for which the index decided is 100, and your exam year May 22 November 22, that year is previous year 21-22, for which the index released recently by way of notification is 317. These are the only two indices that you are required to learn. Base year 0102 100, exam year 21-22 317. Any other index in between, whether 301, 289, all the recent past, all of them will be given to you in the question. So pick up your cost of acquisition, multiply by transfer year, which is always going to be this year, then only capital gain can come in your exam. Divide by CII of acquisition year. If it is base year, you learn it, otherwise they will give it to you. That will give you your indexed cost of acquisition, and that you subtract from your sale consideration, and thus if we subtract higher cost, lower gain, lower tax liability will arise. This is the first benefit of long term capital gain. If your asset is long term, gain will be long term, first benefit. But this benefit will not be available in the following cases. Following cases, the benefit will not be available. 1. Depreciable assets, because they are a part of a block, and in the block there is a deeming fiction, always short term, never long term, always short term, never long term, because of which on depreciable asset there will be no indexation. Slump sale, when an entire business is being sold and the cost of acquisition is net worth of the business, in that case we will not be giving any indexation. Bonds and debentures, very important. Bonds and debentures, whether listed, unlisted, any case, indexation will not be available, with two exceptions: capital index bonds and sovereign gold bonds issued by RBI. On these two bonds, indexation will be available. Any other bonds and debentures, indexation will not be available. This chapter, NRI taxation chapter, we have just started the chapter. We just studied that this is specific assessee, specific income, and we did not go into the detail. But one thing I can tell you, that in this chapter, when we will have capital gain, there will be no indexation on that capital gain, no indexation on NRI taxation. Next, special rates of tax, the very next chapter after this, where we will cover these sections, because the other section 111A, 112, 112A, that we are going to cover here itself. So in these sections also, if there is any capital gain, no indexation. In other words, the next two chapters of our book, whenever you have long term capital gain, there will not be any indexation that you will be eligible for that. Shares or debentures of an Indian company held by a non-resident, whenever non-resident holds securities in India, we give him a benefit. That is the next section. I will teach you that benefit. That rate of tax will always be 10%. Non-resident on securities, whether listed or unlisted, rate of tax will be 10%, and because the rate of tax is already so less, we will not be giving the benefit of indexation to non-resident. And finally, if there is any capital gain under 112A, stock market capital gain, which also we will be discussing after section 112, I will be covering 112A also. Any capital gain on stock market, you will not be getting the benefit of indexation, no benefit of indexation. So there are 7 cases in income tax where benefit of indexation is not going to be available. 7 cases under income tax where benefit of indexation is not going to be available. Now let's go ahead. Second section, second benefit of long term capital gain, section 112. Long term capital gain, the tax rate is going to be a special rate of 20. Now see, observe, 112 falls in chapter 12, 110 to 115 BBG, and thus what we will do, we will segregate our income into LTCG others, LTCG others. LTCG will be taxed at 20%, other income will be taxed at normal rate. And if you remember, this other income will go in old or new, that's your choice, but the special rate will always be applicable. Not just LTCG, but all the sections of special rates of tax will always be applicable. So LTCG will be taxed at a special rate of 20%. You may be having 30% bracket, you may be having anything. Long term, in new regime you can have 25 also, but LTCG will be taxed at 20%. But apart from that, we are also giving the assessee an option, pay tax without indexation benefit at 10%. So what do you do? Sale minus index cost, pay 20%, or sale minus cost, pay 10%. Sale minus index cost into 20%, or sale minus cost into 10%. These are the two options, but this 10% option is available only to listed securities, excluding unit and zero coupon bond. Only on two assets you have this benefit. So if you sell gold, you have only one option, take indexation and 20%. You sell land, building, jewelry, take indexation, pay 20, take indexation, pay 20. But only on two assets you have the option of 10%. Listed securities, zero coupon bond. Listed securities, zero coupon bond. What are the two options? Sale minus index cost into 20, sale minus cost into 10. Sale minus index cost into 20, sale minus cost into 10. These are the two options that will be available to you, and this option can be exercised for every transaction. You sell shares of two companies, one you can take 20, one you can take 10. You sell two shares of the same company, purchased on different dates, sold on different dates. So the gain amount is different. If you purchase and sell on the same price, then 20 will be beneficial for one, then it will be beneficial for all. But if the purchase price and selling price of the two shares of the same company is different, you can take 20 for one and 10 for the other. That is what I mean by the option can be exercised for every transaction. And now listen, if a non-resident is selling listed securities, he will not get indexation because of this, and thus he will take the benefit of 10%, because listed securities you get the benefit of 10%. So no indexation, 10%, no indexation, 10%. But if a non-resident is selling unlisted securities also, we will be giving him 10%. So if you observe carefully, listed they already have an option, but we are giving option for unlisted also. Let me simplify this for you. Whenever a non-resident will sell securities in our country, shares or debentures, no indexation, 10% tax. No indexation, 10% tax. That is going to be the tax treatment on securities for a non-resident. You should give respect to non-resident provisions because of international tax. And with this we come to the last part of capital gains in NRI taxation chapter, section 112A and section 111A, stock market capital gain. 112A is for long term. First we will discuss this and then we go to short term. Long term capital gain will be taxed at 10% on the gain exceeding 1 lakh. So I don't want students to make a mistake here. If the gain is 5 lakh rupees, in taxable income 5 will go, in NTTI 5 will go. Only when you calculate tax, it is like first 1 lakh is like basic exemption and balance 4 lakh you apply 10%. First 1 lakh 0%, balance 4 lakh 10%. Kindly do not make the mistake of saying 1 lakh is exempt, so I will write only 4 lakh in income. No, whatever is your gain amount, full amount will come in NTTI. At the time of tax calculation, first 1 lakh 0, balance 10%. First 1 lakh 0, balance 10%. That is how we are going to be doing. 3 assets will be covered, only 3 assets: equity shares, units of equity oriented mutual fund, and units of business trust. Equity shares, units of equity oriented mutual fund, and units of business trust. In case of the 2 units, STT has to be levied only at the time of sale to get the benefit of 112A. The benefit of 112A, 111A is available only if you have paid STT. Only if you have paid STT. For units, STT has to be paid only at the time of sale. But for equity shares, STT has to be paid on purchase as well as sale if the purchase has taken place on or after 1/10/2004. So listen. First thing, STT has to be paid on sale for all the 3 assets. If STT is not paid on the sale transaction, then this section is not available. It will become like your normal capital gain, where 112 will apply for long term and normal rates will apply for short term. But if STT is paid on sale, for these two, you can take 112. But for equity shares, STT has to be paid on purchase also if purchased on or after 1/10/2004, because this is the date from which India introduced STT. So if the purchase took place after this date, then purchase sale both have to suffer STT. So as far as the rule for purchase has to suffer STT is concerned, be clear. First, it is applicable only for equity shares. For the other two assets, only sale has to suffer STT. Second, only if purchased on or after 1/10/2004. So if you had already purchased in 95, 96, 2000, 2002 and you are selling today, then only sale has to suffer STT. Sale has to suffer always. I am discussing only purchase. Only equity shares, only if purchased on or after 1/10/2004, only under 112A long term. In 111A short term, there is no such requirement. It is only for long term, and that also has some notified exceptions like bonus issue, rights issue. In those cases, if purchase has not suffered STT, still the benefit is going to be available. Even if the purchase transaction has not suffered STT, the benefit is still going to be available. So when does purchase have to suffer STT? Only long term, not in short term. Only for equity shares, not for the other two assets. Only if purchased on or after 1/10/2004, not if purchased before that. And it will also have some notified exceptions, but sale has to suffer STT when? Always, whether long term or short term. All the three assets. Sale you are doing today only, then only capital gain is arising. So it is obviously after 1/10/2004. Sale transaction always has to suffer STT, except that one IFSC case which will come later. I will discuss that with you. So three assets, if STT is paid on sale, and for equity shares subject to the conditions also paid on purchases, then what will happen to long term capital gain? Long term capital gain will be taxable at first 1 lakh 0%, balance 10%. So income will contain full amount, but tax will come only on the excess over 1 lakh. First 1 lakh 0, balance will be 10%. And as far as 111A short term capital gain is concerned, the rate of tax is 15% if STT is paid on the sale transaction. Short term capital gain does not require STT on purchase, only long term requires. And if there is a unit located in International Financial Services Center IFSC, then they are immune from the levy of STT. However, even without STT, the benefit of 111A, 112A will be available. Anyways, for IFSC, there are many tax benefits prescribed under income tax, many tax benefits prescribed. But right now we have studied only this much: short term and long term. Both benefits will be available without STT. Without STT, short term will be 15% and long term will be 10% on the excess over 1 lakh. So this is the stock market provision where we have our first amendment. So if you observe the chapters till now, we did not have any amendment. Now we have first amendment. Equity oriented mutual fund. Can I say equity oriented mutual fund is covered in the provisions of 111A, 112A? If STT is paid, that also only on sale. Purchase has to suffer STT only for equity shares. So equity oriented mutual fund, short term 111A, long term 112A. Short term 111A, long term 112A. From now onwards, equity oriented mutual fund shall also include something called a ULIP, unit linked insurance plan. Sir, what is a ULIP? ULIP means an insurance plan which has the component of both insurance and investment. Whenever we take insurance policies, life insurance policies, they are of two types. Type 1, something called a term policy. Term policy means you pay premium, on death nominee will get money, but there is no maturity value. It is only and only a death benefit, no maturity. That means if you don't die during the policy tenure, the policy is over. That's a term plan. And possibility 2, we get death benefit with maturity benefit. We get, it is like an investment. So whether you die or you don't die, there will be some guaranteed income that will be given. Insurance company comes with a plan that you pay every year this much, and after 35 years, every year we will give you 3 lakh rupees, 5 lakh rupees, something like that. Any term policy is not covered here. ULIP is going to cover that policy which has got insurance and investment both. So term policies which have only death benefit is not covered in this amendment. Only ULIP will be covered, which has got investment and insurance both, which is issued on or after 1st Feb 21. So old policies not covered. New policies, that also only ULIP. If the premium on the policy exceeds rupees 2,50,000 in any year during the policy tenure, then first of all, the exemption under section 1010D shall not be available. Now, first of all, what is 1010D? We do cover this in TDS chapter in our full course lecture. Sir, what is 1010D? Whenever we receive money from insurance company, two occasions, death or maturity. If we receive money on the occasion of death, it will always be fully exempt. If we receive money on the occasion of maturity, then it will be exempt if our premium was within a certain limit, and till now that limit was only prescribed in percentage terms. Any policy issued up to 31st March 2012, that is up to previous year 11-12, then your maximum premium should be 20% of the sum assured policy value. If the policy is issued on or after 1/4/12, that is previous year 12-13 onwards, then maximum premium should be 10% of your policy value. But if the policy is issued on or after 1/4/13, that is 13-14 onwards for handicapped, for disabled, then maximum premium should be 15% of sum assured. If your premium is within the limit, then only your maturity will be exempt. Otherwise, your maturity will be taxable, and thus that TDS section gets attracted. Let's be clear. Death cases always exempt. Always exempt. Maturity cases, premium has to be within the limit which is prescribed. For normal people, earlier it was 20, now it is 10. For handicapped people, first it was 20 like normal people. Then for 12-13, it was 10% like normal people. From 13-14 onwards, normal people will remain in 10% and disabled handicapped people will come in 15%. So that was the percentage limit for exemption of your maturity of insurance policy. But then people used to take very high value, 5 crore policy, 10 crore policy, 15 crore policy, so that their 2 or 3 generations can enjoy, and they have money to pay premium. See, today if I have to pay premium, annual premium of 1-2 lakh rupees, I think, should I spend so much? But there are people who are willing to pay any amount of money because they have a lot of spare funds. So they pay any amount of premium. They say that my lifetime is secured because today I have money. They are rich people. So now the change is that anybody who pays premium exceeding 2,50,000 rupees, it may be within that limit of 20%, 10% or 15%, even if it is within that limit. But if your total premium is exceeding 2,50,000, anyways, in 80C you will get maximum 150 only. But for 1010D exemption, if you have paid premium exceeding 2,50,000, then you will not be eligible for the exemption of 1010D. Your insurance maturity will be taxable. Let's be clear. Only the maturity is going to be taxable. Only maturity. Any amount received on occasion of death shall continue to be exempt. So let's be clear. Death cases, no amendment. Fully exempt earlier, fully exempt now. No amendment. Death cases, no amendment. Amendment has come only in maturity case. Maturity case, earlier exemption was available only if premium is within 20%, 10%, 15%, whatever is applicable. But now, even if it is within that limit, but if you have paid more than 2,50,000, then that exemption will not be available. The maturity of such policies will be now taxable. That means death cases continue to remain exempt. Maturity cases, to get exemption, now 2 conditions. Condition 1, within limit of 20, 10, 15. Condition 2, within 2,50,000 in rupees. So now there is limit in percentage term as well as rupees term. Even if it is within the limit of 20, 10, 15, but you pay more than 2,50,000, your maturity will be taxable. Your insurance policy maturity will be taxable. Are we clear on this? And that maturity will be subjected to STT, and it will be taxable under capital gain. So if you get maturity of an insurance policy which is taxable, when will it be taxable? If your premium is exceeding 2,50,000, it will become taxable. Death cases nahi, only maturity cases. And STT will be levied. And because STT is being levied, we will cover it in the provisions of 111A, 112A by including it in the definition of equity oriented mutual fund. Is equity oriented mutual fund covered here? STT has to be paid on sale only, purchase not required, both for long term, short term. Purchase was required to suffer STT only under long term, only for equity shares. So, equity oriented units only sale has to suffer STT. This definition of equity oriented mutual fund will now also include such insurance policies issued on or after 1/2/21 where annual premium has exceeded 2,50,000 in any of the years. Then the maturity will be taxable. It will suffer STT, and if it is suffering STT, then what rate it will be taxable? It will be treated like equity oriented mutual fund and taxable as per 111A, 112A, and this is also included by way of incorporating a new section in capital gains 45(1)(b). So, in other words, now maturities of insurance policies will become taxable. Are we clear on this? If the premium is more than 2,50,000 and it is a ULIP issued on or after 1/2/21, death will continue to remain exempt, maturity will be taxable, it will suffer STT and then go under 111A, 112A because it is included in the definition of equity oriented mutual fund. So, that was our first amendment. These are revision cum amendment lecture. There are not many amendments this time. No, I'll take my statement back. This is anti. Yes, there are many amendments, but we will come across the amendments chapter by chapter. We will discuss them accordingly. And for 112A, long term capital gain, cost of acquisition, as you are aware, we have grandfathering benefit. So, how will we decide grandfathering benefit? First, we will take sale consideration or FMV on 31st January 18, whichever is lower. First step will be this: sale consideration or FMV on 31st January, whichever is lower. And then this lower amount will be compared with actual cost, whichever is higher. So, sale consideration or FMV on 31st January, whichever is lower, compare with cost of acquisition, whichever is higher. That will be treated as your cost of acquisition for the purpose of 112A. That's the grandfathering benefit. This is revision lecture. I cannot explain the logic of this. Everyone knows this much part. Sale consideration or FMV, whichever is higher. But why we take as sale consideration? That logic is explained in the full course lecture. So, here it is only revision. Selling price or FMV, whichever is lower, compare with actual cost, whichever is higher. Selling price or FMV, whichever is lower, compare with actual cost, whichever is higher. And how will you decide the FMV? If that asset was listed on 31st January 2018, then you take the highest trading value. And if no trading was done on that date, then highest trading value on the last date. When did trading take place? 30, 29, whichever was the last date. How will you decide FMV? See, you have to take FMV, no? Compare with selling price, whichever is lower, then compare with actual cost, whichever is higher. How will you take FMV? If it was listed at that time, then how will you take it? Highest trading value on 31st January. And if no trading had taken place, then highest trading value on the last date when trading took place. What about unlisted? What about it was possible earlier it was unlisted, now it has become listed? Then for unit we will take the NAV on 31st January, and if it was equity shares which was unlisted that time, later it became listed, then how will we compute? We will take the actual cost of acquisition of the assessee and we will give indexation benefit till the financial year 17-18, which happens to be the financial year of this date. So, whenever we had purchased from that year till 17-18, you give indexation, that will give you your fair market value of equity share. With this fair market value, whether this or this, whichever is the case, for listed it is going to be highest trading value, and if no trading, then last trading date. If it was unlisted at that time, then for unit we will take NAV. For equity share from the year of purchase till 17-18, we will give indexation, that will give our FMV. FMV compare with selling price, whichever is lower, that lower amount compare with actual cost, whichever is higher, that will become our cost of acquisition. Subtract from selling price, we get gain. Full gain will go in income. Full gain will go in income at the time of tax calculation. First 1 lakh 0%, balance will be taxed at 10%. And let us understand the points to be noted with respect to this discussion. First, 25 and 37% surcharge is not applicable on these two incomes, 111A, 112A. Remember, 4 incomes which cover these two. There is one more, 115AD, and there is dividend. Very important, against 112A, you will not get any rebate. See, already if you observe first 1 lakh, you are not paying any tax. No? If that was also taxed at 10%, then you would pay 10,000 tax. That means already you are saving 10,000. How 10,000? First 1 lakh is not taxed. Balance is taxed at 10%. So on that first 1 lakh, if we apply 10%, then you will have 10,000, but we are not applying. And thus we will not give you the benefit of rebate. Next, there will be no chapter 6A deduction against these two incomes. In fact, any income taxable at special rate, no chapter 6A deduction, whether this chapter or the next chapter, any income taxable at special rate, no chapter 6A deduction, with two exceptions. One, there is royalty and fees for technical services in the next chapter, special rates of tax, and there is against which you can take chapter 6A deduction, and there is a section 80 LA specially created for International Financial Services Center. In these two cases, you can take chapter 6A against a special rate. Otherwise, chapter 6A will not be allowed against any income taxable at special rate. Under section 112A, full capital gain is included in NTTI. At the time of tax calculation, first 1 lakh 0, balance 10. Something that I have been continuously telling you. Next, very important place to make sure that you don't lose marks. 2 people, 3 incomes. 2 people, 3 incomes. 2 people, 3 incomes. 2 people, 3 incomes. Resident individual and resident HUF. Which 2 people? Resident individual and resident HUF. And which 3 incomes? 111A, 112 and 112A. This is all types of long term capital gains. 112A covers only long term capital gain on stock market. 112 will cover all other long term capital gains, and 111A will cover your short term capital gain on stock market. All types of long term capital gain and stock market short term capital gain. If you have these 3 incomes and you are resident individual, resident HUF, then you will be allowed to utilize your unexhausted basic exemption limit. Supposingly this is your only income for the year. So before you directly apply 15% or 20% or 10% on the excess over 1 lakh, first take your unexhausted basic exemption limit. Only 2 people, resident individual, resident HUF, only 3 incomes, 111A, 112, 112A, 2 people, 3 incomes, 2 people, 3 incomes, allowed to utilize basic exemption limit. And in 112A, if there is any loss, it will be eligible for full set off and carry forward. Supposingly you don't have 5 lakh gain, you have 5 lakh loss. Possible? Now don't make the mistake of saying, sir, if there is 5 lakh loss, I will get set off of only 4 lakh or carry forward of any only 4 lakh. No sir, because full profit goes in income. Full profit goes in income, and therefore full loss will be eligible for set off and carry forward. Full profit will go in income, full loss will be eligible for set off and carry forward. This is the tax treatment of your capital gains, which we study before we actually study our main chapter, NRI taxation. Before the main chapter, NRI taxation, this is the capital gain part that we all study. Let's go ahead. Apart from the NRI taxation part and the capital gain part, this is also the chapter where we cover the residential status part, because this chapter is applicable only to non-resident, and at CA final, due to international tax, you should know when a person becomes non-resident. Intermediate students already are required to know residential status because it is a chapter on which they may be asked questions, but at final also, because of international tax, you need to now know what or how to identify resident and non-resident. An individual will be a resident if he falls in any of the following 3 cases. Condition 1, if you stay in India for a period of 182 days or more during the previous year, equal to 182 also covered, then you will be treated as a resident. Condition 2, if you stay in India for 60 days or more during the previous year and 365 days or more during the last 4 years. So current year 182, resident. Current year 60, last 4 years, total 365, total equal to also covered, then you are a resident. Or condition 3, if your total income in India, income from sources in India, Indian income, plus if your income which is arising outside India but the business or profession is controlled from India, means Indian income we will take total, all sources. Foreign income we will take only if it is controlled from India, and that total is exceeding rupees 15 lakh rupees. Modi ji's favorite figure, 15 lakh. Total is exceeding rupees 15 lakh. Let's be clear. Indian income total and foreign income only if it is controlled from India. If that total is exceeding 15 lakh rupees, assessee is a citizen of India. This provision is applicable only for assessee who is citizen of India, and you are not liable to tax in any country due to your residence. You are, in other words, non-resident in any other country, all other countries. You are not a resident anywhere. What are the conditions? Condition 1, you are citizen. This is easy. You are citizen. Okay. Condition 2, you are not a resident anywhere else. So, if you have become already a resident, tax resident anywhere else, then this provision not applicable. And condition 3, income exceeding 15 lakh. Which income? Indian income total. Foreign income only if controlled from India, then the assessee will be treated as a resident. So, current year 182, current year 60, last 4 years 365, or total income exceeding 15 lakh, when total will include Indian income plus foreign only if controlled from India. You are a citizen and not a resident anywhere else, then you will be treated as resident in India, and don't forget, once you are resident, your world income will start getting taxed. Is that clear? But there are two cases in which condition 2 is not applicable. Condition 2 means 6365 not applicable. 6365 not applicable. Which two cases? A citizen of India who leaves India for the purpose of employment or as a crew member of Indian ship. Citizen of India who leaves India for the purpose of employment or as a crew member of Indian ship, and for crew member, the period in the continuous discharge certificate, the contract for giving services to the shipping company without holiday, that period will not be included in his stay in India. Supposingly the CDC is still going on, but you have already come to India, so that period will be excluded. So, citizen of India who leaves for the purpose of employment or as a crew member of Indian ship, then 6365 will not be applicable. And for crew member, while counting the number of days, so 6365 not applicable means only 182 is applicable. And while counting that, CDC period for crew member will not be included. And the second person for whom 6365 is not applicable, if you are a citizen of India or a person of Indian origin who is coming to India, be very clear, coming to India for the purpose of visit. You are coming to India for the purpose of visit. Very important to note, this is only and only if it is visit. So, if you come to India for earning, then this exception is not applicable and 6365 will be applicable to you. 6365 is not applicable for citizen of India or person of Indian origin coming for a visit. However, if that same income, which income? Income in India and outside India from business controlled from India. Indian income total and outside India, if the business is controlled from India, if your total income exceeds 15 lakh rupees, then that condition 2 will apply. But it will not be 6365, it will be 120 in the current year and 365 in the last 4 years. 6365 will apply, but not like its normal form. Instead of that, it will be 120 365, not 6365, but 120 365 is going to be applicable. And step number 2, we decide whether the assessee is ROR or RNOR, resident and ordinarily resident, or resident but not ordinarily resident. First of all, you should understand that this is applicable only if the assessee is resident, because under non-resident, there is no bifurcation called ordinary or not ordinary. And secondly, as far as this chapter is concerned, here the assessee has to be non-resident, then only the chapter is applicable. If the assessee is resident, this chapter is not applicable. So, this may not be relevant for this chapter, but it is definitely relevant for other chapters, and assessee will become ROR if both conditions are satisfied. So, we are giving you two conditions. Both conditions are satisfied, then you are ROR, otherwise you will be RNOR. What are the two conditions? You stay in India for 730 days or more during the last 7 years. Last 7 years, 730 days, and last 10 years, minimum 2 years you should be a resident. 730 days during last 7 years and 2 out of last 10 years minimum you should be resident. If both conditions are fulfilled, then you are ROR, otherwise you will be RNOR. And the two assessees who became resident because of 15 lakh, one that resident. Which one? Citizen more than 15 lakh, not a resident anywhere else. That person in condition 3 in step number 1. And second, that citizen or PIO who came for visit and we applied 12365. Those two assessees will always be RNOR. They may be resident, but they will always be resident, but not ordinarily resident. We will not apply the ordinary resident condition on them. So this is the discussion of capital gain and residential status before we actually start our main chapter, NRI taxation. And now let's go and discuss what is this chapter. As we discussed in the beginning, this chapter is applicable only on specific assessee, specific income, only if the combo takes place. If the combo does not take place, normal rate, and when the combo takes place, you have an option, normal or special, whichever is beneficial. So when does the chapter apply? Who is NRI? 3 conditions. 1, this chapter is applicable only to individual, That means company, firm, AOP, BOI, HUF, etc. not covered. Second, you have to be citizen of India or person of Indian origin. Citizen of India or person of Indian origin. You have to be any one of them. And third, you have to be a non-resident in India during the previous year of income, or you can also be in the year of acquisition of the foreign exchange asset. If you are non-resident in the year of acquisition of the asset, then you will be covered in this chapter, even if in the year of income you have become resident. So 3 conditions to become specific assessee. 1, individual, second, citizen or PIO, any one of them, and third, non-resident during the previous year. And this foreign exchange asset definition includes the following assets: shares of an Indian company, it can be listed, unlisted, public, private, anything. Debentures and deposits only if it is public company. Securities of central government and any other notified asset. You are going to be having 2 incomes arising from forex asset. First of all, who is the specific assessee? Individual, citizen or PIO, non-resident. Individual, citizen or PIO, non-resident. And now what are the incomes? From this foreign exchange asset, you can have 2 income: investment income or long-term capital gain. Only two. All other income, salary, house, property, PGBP, if you have normal rates. Short-term capital gain also normal rate, because special rate is applicable only if you are having long-term capital gain. So 2 incomes from forex asset. What is forex asset? Shares, debentures, deposit. Shares of all companies, debenture, deposit of public company, central government security, any other notified. And what are the 2 incomes? Investment income and LTCG. Investment income will be the income arising. So you can have dividend, interest, all those incomes are investment incomes. And LTCG, of course, at the time of transfer of capital asset. If the asset is long term, gain will be long term. You have this chapter. If it is short term, then normal rates will apply. If you opt for this chapter, special rates of tax of NRI chapter 12A, this is optional. If you opt for this, then there are some restrictions. That means if you go for normal rates, you have the option. It's an optional chapter, so you have the option of going to normal. Then the restrictions are not applicable. These restrictions are applicable if you opt for special rate. What are the restrictions? If you have any expense incurred against investment income, it will not be allowed. For LTCG, transfer expense, brokerage, cost of acquisition will be allowed, but for investment income, expenses will not be allowed. Indexation benefit will not be allowed. That is where we studied list of cases where indexation benefit not available. Chapter 12A was a part of it. Chapter 6A, not allowed against both, because we know whenever an income is taxed at special rate. So in this chapter, we will apply special rate for both. Whenever an income is taxed at special rate, no chapter 6A. And basic exemption also not allowed. That also we studied. Only 2 people, 3 incomes, 2 people, 3 incomes. So no deduction of expense against investment income. Against LTCG you will get. No indexation against LTCG. Here it is not applicable, obviously. And chapter 6A and basic exemption you will not get against both. Chapter 6A and basic exemption you will not get against both. These are the restrictions only if you opt for NRI. If you don't opt for NRI, these restrictions will not be applicable. And finally, what are the special rates of tax? For investment income, we will apply 20%, and for LTCG, 10. Only 2 incomes covered here. Investment 20%, LTCG 10. Investment 20, LTCG 10. All other incomes will go in normal rate. So we will have three bifurcations. Investment income 20, LTCG 10. All other incomes will go in normal rate. Surcharge HEC will get added because this is the basic tax rate. Surcharge, if applicable, we have already studied the rates in the introduction. and HEC is always applicable, that we are aware of. If these two incomes arising out of foreign exchange asset, then this is going to be the rate of tax. On the LTCG arising, where you are paying 10% tax, if you want, you can save your tax. The concept is similar to sell one asset and invest in another asset. So LTCG arising from transfer of foreign exchange asset shall be exempt if the net sale consideration is utilized within 6 months from the date of transfer another forex asset or certificate under 10(4)(b). This was NSC, National Savings Certificate, up to 2002. So practically this has become redundant. You can ignore this part. If you want, this part can be ignored. Okay, this certificate part can be ignored if you want. You focus on this. Within 6 months from transfer, acquire another forex asset. Within 6 months from transfer, acquire another forex asset. If the net sale consideration is invested, then your entire capital gain will be exempt. And if entire amount is not utilized, then proportionate exemption. This calculation is similar to section 54F. You have to invest the sale amount, and if you don't invest the sale amount, proportionate exemption will be available to you. If entire net sale consideration is invested, entire capital gain will be exempt, otherwise proportionate will be exempt. If you have only these two income, which two? Investment income LTCG, investment income LTCG, investment income LTCG. If you have only these two income, no other income, and TDS has been fully deducted, only two incomes and TDS is fully deducted, only two incomes and TDS is fully deducted, then no need to file return of income. This facility is also available for 3 more sections in special rates of tax. Totally there are 4 cases in income tax, 1 in NRI, 3 in special rates, 1 in NRI, 3 in special rates. And what are the 2 conditions for getting this facility? No other income, TDS deducted, no other income, TDS deducted. If you fulfill these conditions, then in that case, no need to file return of income. No other income, TDS deducted, no other income, TDS deducted, no need to file return of income. 1 section we have studied here, 3 in the next chapter. Next, even if the assessee becomes resident, then normal provisions will apply, but till the time you hold the forex asset, you can use the option of special rate if you were non-resident in the year of acquisition. I already told you here itself that you have to be non-resident. This can be in the year of acquisition of the asset. So when I purchase the asset, at that time if I was non-resident, then till the time I hold the asset, I will be eligible for the special rate of NRI. If I am non-resident in the year of purchase, then I can avail the option till the time I am holding the asset, and option can be changed every year on a year-on-year basis. And this section we already saw in the beginning also. If the normal provisions are beneficial, then the assessee can go for normal provisions, because this chapter NRI taxation is going to be optional. That's our chapter number 4, big chapter, because we studied capital gain and residential status also here. Moving on, next chapter of our book, in the order of our book from our handwritten book, special rates of tax. Here we will cover this chapter 12. That was chapter 12A. Now we are studying chapter 12. The actual range of chapter 12 is this, from 110. But in this chapter, we will learn only the section starting from 115A to 115BBG. We will learn only this range, because the sections before 115A, that is 111A, 112, 112A, we have already studied in NRI taxation. They are a part of chapter 12, but we have studied already in the previous chapter. So we will here in this chapter learn only 115A to 115BBG. Other sections are already covered. This chapter is also applicable only to specific assessee, specific income, only if the combo takes place. Only if the combo takes place. Specific assessee, specific income, only if the combo takes place. That means normal assessee, normal income, normal rates. Specific assessee, normal income, normal rates. Normal assessee, specific income, normal rates. Only if the combo takes place, specific assessee, specific income, then only this chapter will apply. But the main difference between NRI and this chapter, chapter 12 and 12A, if it was not this difference, I would have merged them into one chapter and taught it together. The main difference is that these rates are compulsory, and NRI was optional. So unlike NRI, this is compulsory. Compulsory even in the new taxation regime. This is what I told you. Even in the new regime, it is going to be compulsory. These rates are going to be compulsory even in the new taxation regime. So you can divide your income into two categories. You divide your income in two categories. What two categories you will divide? Normal income, special income. Normal income you can take old or new based on your option, but special income will go in special rate and compulsory even in the new regime. That's the main difference. So if the combo takes place in NRI, you do both calculation, see which is beneficial, but in special rate this is going to be compulsory. And when this is compulsory, obviously the restrictions, which restrictions? Which restriction? Those restrictions which apply in NRI taxation, obviously those restrictions are going to be applicable. The restrictions like no basic exemption, no deduction of expenses, no chapter 6A deduction, no indexation benefit. Obviously the rates that we will do here are going to be your basic tax rate. So we will be adding surcharge and cess in all the rates that we will be doing. If there is any DTAA, you can take the benefit. When we say compulsory, it is compulsory compared to normal slab rates. But if there is a DTAA which is more beneficial, you can always take the benefit of DTAA. So the restrictions are only going to be in this much. The first 4 points. Restrictions will be only to the extent of the first 4 points. Only the first 4 points are restrictions. That is no basic exemption, no deduction of expense, no chapter 6A and no indexation benefit. These 4 restrictions will apply. In NRI chapter they apply only if you opt, but here it is compulsory, so they will always apply. Now let's go to the sections one by one. The first section is one of the most important sections of your entire syllabus, section 115A. First section, section 115A. This is applicable on which incomes? Interest income. This is applicable on dividend income, interest income, dividend income, royalty, fees for technical services. Multiple incomes covered in the section. One by one we will see what are the rates of the different incomes. First of all, the assessee covered here is only non-resident and foreign company. That means resident will not be covered, non-resident, foreign company. One by one. If there is dividend income other than business trust, so all other dividend incomes, 20% will be the rate of tax. But if it is business trust dividend, then it will be 10%. In other words, dividend from business trust for non-resident 10% and other dividend 20. Dividend from business trust 10, other 20. Next, any interest that you earn on a foreign currency loan, that means non-resident must have given loan to someone in India, the rate of tax on that loan will be 20%. However, in some cases 5% concessional rate will apply. So normal rate of tax on interest will be 20, but what are the cases where 5% will apply? 1. Any interest that you receive from infrastructure debt fund to promote infrastructure, 5%. Any interest that you receive from Indian company on long-term bonds and the agreement is approved by central government. Indian company long-term bonds, approved agreement. Indian company long-term bonds, approved agreement. Any interest income of a foreign institutional investor or qualified foreign investor from rupee denominated bonds of Indian company. So interest which you are receiving, you are the QFI, you are the FII, then it will be 5%. But if it is rupee denominated bonds, any interest that you are receiving as unit holder of business trust, that will be taxable at 5. So both under dividend as well as interest from business trust you get concession. Under dividend normal rate is 20, but for business trust dividend it is 10. Likewise under interest normal rate is 20, but for business trust interest it is going to be 5%. Any interest received from municipal debt securities, so you have invested in the debt securities of municipal corporation, then in that case the rate of tax of 5% is going to be applicable. But the rupee denominated bonds which were covered in this point here, rupee denominated bonds which are issued during this period 17 September 18 to 31st March 19, that temporary period there was a benefit prescribed for assessees if it was issued during this period. So even today it is relevant, because if it was issued in this period, even today it will be exempt. You don't have to see the year of interest. If it is your exam, it has to be 21-22. You have to see the date of issue. If it is 17 September 18 to 31st March 19, then the interest on rupee denominated bonds will be exempt, and after 1/4/19 it became taxable at a rate of 5%, at a rate of 5%. But if it is long term rupee denominated bonds which are issued on IFSC from 1st April 20 to 1st July 23, then in that case it will be 4%. Before 1st July means up to 30th June of 23, because earlier for IFSC it was exempt. Let me put this straight. Rupee denominated bonds, FII, QFI, 5%. But if issued during this period, it will be exempt. Rupee denominated bonds during this period, 17 September 18 to 31st March 19, will be exempt, and after that it is going to be taxable at 5%. As far as IFSC bonds were concerned, long-term bonds on IFSC was concerned, anything issued after this date, 1st September 19, was exempt. But suddenly, Aunty changed the rule. Aunty says no, this exemption will be only if the issue takes place up to 31st March 20. If issued from 1st April 20, I will remove the exemption. I will start taking tax, but I will take tax at a low rate, 4%. So not 20, not 5, but a low rate of 4%, but it is going to be taxable. It will not be exempt anymore. So IFSC from 1st September it was exempt, 1st September 19, but from 1st April 20, the rate of 4% will be applicable, and other cases issued during this period it will be exempt. Thereafter 5% is going to be applicable. Any assessee in IFSC will be eligible for 80 LA deduction, and this is available even against special rates. There are two chapter 6A which are available against special rates. One, royalty FTS, which we will come across in this section only, and second, this 80 LA deduction. What is the deduction? 100% deduction of profits. Full profits will be 80 LA deduction. So profit will come in income deduction, but that benefit will be available only for 10 years. But which 10 years? They have to be continuous. So you cannot take year 1, 3, 5, 7, 9 or 2, 4, 6, 8. It has to be 1 to 10. Continuous 10 years, and they have to be out of the first 15. So you cannot take 11 to 20. You can take 1 to 10, 2 to 11, 3 to 12, 4 to 13, 5 to 14 or 6 to 15. These are your only options. You can take full deduction of your profit. So 10 years, continuous years out of first 15. 10 years, continuous years out of first 15. That is going to be your deduction under 80 LA, and even against the special rates you will be eligible for this deduction. This deduction will be available even for incomes which are taxable at special rates. Next, any share of profit that you receive from mutual fund, units of UTI or mutual fund, that also for non-resident will be taxable at 20. See, dividend was also taxable at 20, business trust was only an exception, and share of profit from mutual fund will also be taxable at 20%. And the last two incomes, if a non-resident is earning royalty and fees for technical services, royalty FTS in India, royalty FTS, then the rate of tax will be 10%. Royalty FTS will be 10%, and chapter 6A will be allowed. Chapter 6A deduction is not allowed against the special rates. Two exceptions, royalty FTS. So dividend interest also not allowed, royalty FTS and 80 LA. Royalty FTS and 80 LA. Two cases where you get chapter 6A deduction against the special rates. Two cases where you get chapter 6A deduction against special rates. Royalty FTS, 80 LA. Royalty FTS, 80 LA. And what is the tax rate of royalty FTS? 10%. But if you are covered in 44DA, what is 44DA? Applicable to a non-resident, where you have option to pay tax at normal rates with deduction of expense. So take deduction of expense and pay tax at normal rates. For foreign company it is 40%, for partnership firm it can be 30%. Whatever is your normal tax rate will be applicable, provided you fulfill the three conditions. Condition 1, you should have permanent establishment in India. Condition 2, you should maintain books of accounts, of course with respect to that PE, and every time there is books of accounts, get them audited. PE books audit, PE books audit, PE books audit. If you fulfill the three conditions, then you get this option. That means, let me be clear, if you don't fulfill the three conditions, then you have to take this 10%. Finished. If you fulfill 10% without deduction of expense, let me remind you that in this chapter deduction of expense not available. So 10% on the gross income, sales amount. But if you fulfill the three conditions, then we give you another option, take deduction of expense, then on the profit figure apply normal rate. So 10% on sales or normal rate on profit, but only if you fulfill the conditions. 10% on sales, normal rate on profit, only if you fulfill the 3 conditions. If you don't fulfill the conditions, directly 10% under 115A will be applicable. However, if you receive royalty or FTS from NTRO, National Technical Research Organization, that royalty or FTS for non-resident has been specifically exempt under section 10. So that was your first, biggest and most important section of the chapter 115A. Other sections are not so big. Next section, tax on 115AB, tax on income from capital gain or unit purchased in foreign currency, applicable to OFO and offshore funds, overseas financial organization and offshore funds. Overseas financial organization and offshore funds are going to be covered here. 10% tax will be levied. OFO and offshore funds, 10% tax will be levied. On what income? Any income which is arising from units of UTI or mutual funds. So what do OFOs do? They invest in mutual funds. So share of profit will be 10%. And any LTCG, no indexation. Remember, in this chapter, there will be no indexation. Obviously, we are giving you rate of tax of 10%, which automatically means that there will be no indexation. But mind you, only 2 incomes, share of profit and LTCG. Share of profit, LTCG. Any other income. When I say any other income, primarily my target is short-term capital gain, because they can sell the units as short-term also. Normal rate will apply. Special rate is applicable only if it is share of profit or LTCG. Share of profit or LTCG. So, OFO will come to India, invest in mutual fund units. It will get share of profit. And when it will sell the units, it will get capital gain. Long-term capital gain. Short-term will go in normal. Only share of profit and long-term capital gain, 10% tax rate will apply. Next, 115 AC, applicable to again non-resident. This is also for non-resident. 10% tax rate will apply on the following incomes. First income, interest from notified bonds of a public sector company or bonds of any notified Indian company. So listen, if the company is notified, it can be any Indian company, any bonds. But if the bonds are notified, it has to be public sector company. Bonds notified, public sector company. Company notified, any bonds. Bonds notified, public sector company. Company notified, any bonds. Interest income. And if you get dividend from Adr Gdr, so you have invested in Indian securities, you deposit them with an overseas depository participant. In return, you get Adr Gdr and you do trading in that Adr Gdr. So you will get dividend from Adr Gdr. So interest from these bonds and dividend from Adr Gdr. Which bonds? If bonds are notified, then public sector company, and company is notified, then any bonds. And dividend from Adr Gdr and LTCG on if you sell these bonds or this Adr Gdr. Sell bonds or Adr Gdr. LTCG. Once again, LTCG is covered, means short term will go in normal. All these incomes will go in 10%. Of course, because it is 10%, there will be no benefit of indexation. So, interest income, dividend income and LTCG, all 3 will be taxed at 10%, no indexation benefit. Next, section 115 ACA. For the first time, we will be having resident employees of Indian company covered. Who is the assessee? Resident employees of Indian company or their subsidiary company. That means there is an Indian company, you are an employee of that company, or that Indian company has got a subsidiary, and this subsidiary can be also a foreign company, and you are employee of that foreign company, but you have to be resident. So, resident employee of Indian company or resident employee of subsidiary of Indian company, and that company is engaged in specified knowledge based industry or service. So, A Limited is an Indian company which is in the business of knowledge based industry or service. It has got a foreign subsidiary, X Incorporation, which is also engaged in knowledge based industry or service, and I am employee of any one of these companies. I can be employee of Indian company or I can be employee of the subsidiary, but the company has to be engaged in knowledge based industry and I have to be resident. First, I will make it clear what is knowledge based industry or service. Knowledge based industry or service will cover the following. Following are going to be covered in the definition of knowledge based industry or service. I'll write them here. I think somewhere I cannot find it. I'll write them here. Information technology software is a knowledge based industry. Information technology service. So your companies like TCS, Infosys, all will come here. Biotechnology companies. Next, pharmaceutical company. entertainment company and any other notified. IT software, IT service, pharmaceutical, biotechnology, entertainment and any other notified. 6 industries are knowledge based industry or service. The company is doing this business, and I am a resident employee of that company or a subsidiary of that company which is doing this business. I am an employee of an Indian company doing this business or subsidiary of an Indian company doing this business, and I am resident. So tax at 10% will be levied on what? This company has given me Adr Gdr. Matlab this company has allotted me ESOP under employee stock option plan, and I have exchanged them to acquire Adr Gdr. Understand the chronology. I am an employee of any of these companies. I am allotted ESOP. That ESOP I exchange for Adr Gdr because I am doing trading in securities. So I exchange. And if I am earning any dividend income from that Adr Gdr or LTCG without indexation, then both incomes will be taxed at 10%. Because the rate is 10%, it will be without indexation, and once again short term will be taxable at normal rate. So let's be clear about the condition. I am resident employee of a company doing knowledge based industry or service. This is knowledge based industry. IT, software, service, biotechnology, pharma, entertainment, any other notified. That company can be Indian company or that company can be subsidiary of an Indian company which is a foreign company, but I have to be resident. Company has allotted me ESOP. I exchange ESOP for Adr Gdr and I do trading. I get dividend. Dividend will be taxable at 10% and LTCG will also be taxable at 10% without indexation. All other incomes including short term capital gain will be taxable at normal rate. And under Adr Gdr, first of all, Adr Gdr means securities issued by an overseas depository participant in exchange of Indian securities. That was the existing meaning for both sections, 115 AC and ACA. What do you mean by Adr Gdr? I am holding securities. I go to overseas depository participant, give them my securities, and in exchange I get Adr Gdr with which I do trading. So till now Indian securities were covered, and now with effect from AY 22-23, any receipt which is issued by IFSC to an investor against issue of listed shares of an Indian company or foreign currency convertible bonds of the issuing company, or with effect from AY 22-23, listed shares of a foreign company if they are being traded on IFSC, they will also be covered. What is Adr Gdr? Adr Gdr means a depository receipt with which you can do trading, which is issued to you by overseas depository participant. They are in the business of this, dealing in securities. Okay, so that overseas depository participant has issued that to you, and with effect from AY 22-23, it can be IFSC also that is issuing Adr Gdr to you. Against what? If you have shares of an Indian company, go to the overseas depository participant, give the shares, take Adr Gdr. Or if you have foreign currency convertible bonds of the issuing company, it can be shares or bonds, shares or bonds, shares or bonds. Go to the overseas depository participant and take Adr Gdr. But now we will cover IFSC transaction also. So I am holding listed shares of a foreign company in IFSC. IFSC is going to be a stock exchange in India only, but immune from certain tax applicabilities, certain tax provisions. I have invested in listed shares of a foreign company in IFSC. Now with these shares, I go to the IFSC, give the shares and take depository receipts. That will also be Adr Gdr for the purpose of applying the tax rate under 115 AC and ACA. So understand them on a one-to-one basis. With depository participant, I can give them shares or bonds of the issuing company and get Adr Gdr. And with IFSC, I can give them shares of foreign company trading in IFSC and get Adr Gdr. And 115 AC and ACA will be applicable for the purpose of both these provisions. Okay. Next, section 115 AD, which was applicable till now only to FIIs, foreign institutional investor, was covered here under 115 AD. And once again, one more amendment here. With effect from AY 22-23, we will now be also covering certain specified funds. So from now onwards, 115 AD will have two assessees. FIIs was already there. What is the amendment? Now it will also include specified fund. Now sir, what do you mean by specified fund? Specified fund means a fund which is established in India as a trust company, LLP, body corporate, registered under the SEBI regulations and located in IFSC. So fund established in India, It can register as a trust company, LLP, anything. It is registered under the regulations laid down by SEBI, located in IFSC, and all the units other than the promoter, sponsor, manager are held by non-resident. It will also include the investment division of an offshore banking unit registered under SEBI regulations and fulfilling prescribed condition. Let me explain one by one. First of all, 115 AD, existingly covered FIIs, that is not an amendment. FIIs are covered here. What is a specified fund? Under IFSC, this provision will be applicable. You create a fund which is taking registration as a trust company, LLP, anything. You take registration under the SEBI regulation and the fund is incorporated in IFSC, and because it is a fund, it will be issuing units. All the units are held by non-resident. A fund where all the units are held by non-resident under SEBI regulations in IFSC and incorporated as company form, LLP, a company, LLP, trust or body corporate. And what is it? What is the business? It will be in the business of investment. In fact, it will also include investment division of offshore banking unit. Complicated language used. If I have to make it simple, you can call it Indian branch of foreign bank. Indian branch of foreign bank. Most of the banking companies are involved in investment business. For example, we have ICAI Securities, HDFC Securities. So, if a foreign bank has an Indian branch which is in the business of investment, any foreign, for example, Citibank, foreign bank engaged in, HSBC, for example, engaged in investment activities, then understand, investment division of an offshore banking unit registered under SEBI regulations and fulfilling prescribed condition in the business of investment, then that will also be covered in the definition of specified funds. So, now along with FII, we will also cover specified funds here. So, that means, can I say FIIs and specified funds both are engaged in investment activities in our country? Both of them are doing investment activities, investment business. So, that means they will be earning income. Any income from securities, then it can be form of shares, dividend, anything. For FIIs, it will be taxable at 20%. So, investment income will be taxable at 20% for FIIs. But any income earned as QFI, FII or QFI, rupee denominated bonds, that will be taxable at 5%. So, FII's income will be divided in two categories. QFI 5%, other 20. QFI 5%, other 20. But for specified funds, which is an amendment, of course, because specified funds have been included from this year onwards, the rate applicable is only going to be 10%. So, understand the breakup. Specified fund 10%. FIIs, two categories. Normal income 20, QFI 5. Normal income 20, QFI 5. But specified fund, we will apply 10% tax rate. This is the tax rate applicable on investment income. Both of them are engaged in investment activities, investing in securities. So, they will be earning money, earning profit from investment. This is the tax rate. And what if they earn capital gains? Long-term capital gain without indexation benefit will be taxable at 10%. Because the rate is 10%, obviously there will be no indexation, and if conditions are fulfilled, then we will also give you the benefit of 112A. That means, if it is equity shares or units of equity oriented mutual fund or units of business trust, STT paid at the time of sale, and for equity shares after 1/10/2004, STT also paid on purchase for long term. Short term it is not required. Then we will give you that first 1 lakh benefit also, and balance will be taxable at 10%. So, long term capital gains 10% without indexation, 112A available. As far as short term capital gain is concerned, if it is covered by 111A, again those same three assets, STT paid only on sale, for short term purchase is not required to have STT, then 15%, and if it is not covered, then 30%. If covered, then 15%, not covered, then 30%. So, long term capital gain 10% without indexation, short term capital gain 111A, if covered under 111A, then 15%, and if not covered, then 30%. Okay, but incomes of specified funds which are included in the section with effect from AY 20 to 23 earned on IFSC shall be exempt. So, any of these incomes, if specified fund is earning on IFSC, then it will be exempt. That is again an amendment. So, specified fund will pay tax on revenue income at 10%, on capital gain at these rates. For revenue income, they have special rate 10%. FIIs will have 20 and 5. Specified funds will have 10%. Capital gains, it is same for both 10, 15 and 30. Long term 10 without indexation, short term 111A 15, other cases 30. But if it is earned on IFSC for specified fund, that will be exempt. Income of specified fund on IFSC is going to be exempt. Next section 115BB, winning from lottery, crossword puzzle, betting, gambling. This is probably that only section of special rates of tax which students study also in CA intermediate. Okay, so all assessees, if they have income from lottery, crossword puzzle, card game, horse races, any other activity of the nature of betting, gambling, that is casual winning, 30% tax, as you are all aware. 30% is going to be the applicable tax rate on casual winnings. Next, income of non-resident sportsman, sports association or entertainer. First, non-resident foreign national sportsman. Second, non-resident foreign sports association. Third, non-resident foreign national entertainer. Three assessees: foreign national sportsman, sports association, entertainer. Non-resident foreign national sportsman, sports association, entertainer. Tax rate will be 20%. So we have a sportsman here, we have some sports association, and we have this girl Justina Bieber, foreign national entertainer. For sportsmen, participating in any game or sport, participating in any advertisement, getting ad revenue or contribution of articles in media. Three incomes. For sportsmen, game or sport, advertisement, articles. Game or sport, advertisement, articles. For sports association, only one income, guaranteed amount. And for entertainer also, only one income from performances in India. All the incomes will be taxable at a rate of 20%. Sportsmen, sports association, entertainer, they have the respective incomes. I'll repeat: for sportsmen, game or sport, advertisement, articles. Game or sport, advertisement, articles. For sports association, guaranteed amount, only one income, guaranteed amount. And for entertainer, only one income, performances. Only one income, performances. Non-resident foreign national sportsman, non-resident foreign sports association, non-resident foreign national entertainer. For the three respective incomes, for their respective incomes, the three assessees have 20% tax rate. Of course, TDS has to be deducted as the assessee is non-resident. There is a section, special section for this. 194E will apply. TDS will get deducted in 194E. There was a decision by Calcutta High Court in the case of an assessee called Indcom. Umpire, Billy Bowden is here. Umpire, coach, referee, they are not sportsmen. So 115BBA will not be applicable. Normal rate of tax will apply, and of course TDS will come in 195, not in 194E. And third, and very important, this section 115BBA, first section of the chapter, most important section of the entire chapter, and 115AC, notified bonds of public sector company or bonds of any notified Indian company, Adr Gdr. Three sections, 115A, AC, BBA, AAC, BBA. No need to file return of income if no other income, TDS deducted, no other income, TDS deducted. So total 4 cases in income tax, 1 in NRI and 3 year. 115A, AC, BBA, AAC, BBA. And what are the two conditions? No other income, TDS deducted, no other income, TDS deducted. If there is no other income and TDS has been fully deducted, in that case, the assessee will not be required to file return of income. No need to file return of income. Next, section 115BBD. If there is dividend income which is received from a foreign company, then what will be the tax rate for the Indian company? So, who is the assessee? Indian company. An Indian company which is getting dividend from a foreign company. Which foreign company? Not all companies. All foreign companies not covered. Any foreign company in which the Indian company holds 26% or more of equity shares. So, I am an Indian company. I have invested in a foreign company and I hold minimum 26% voting power. Minimum holding has to be 26%. If an Indian company holds 26% or more voting power in a foreign company, then on that dividend 15% concessional tax will apply. So, if I hold 1, 2, 5, 10, 20%, then normal rate will apply. 25% normal will apply. Exact 26, then 15% will be applicable because equal to is also covered. So, any Indian company holding 26% or more in a foreign company, any Indian company holding 26% or more in a foreign company, then 15% tax rate is going to be applicable. Any Indian company holding 26% or more in a foreign company, then 15% tax rate will apply on the dividend income received. Next, section 115BBA. Any kind of unexplained, most important word, unexplained. Unexplained what? Unexplained cash credit. So, you have cash but you don't have explanations. unexplained investment, unexplained money for not fully disclosed investment. If you are incurring any expenditure but you don't have any information about the source, any amount borrowed or repaid on hundi. Hundi was an old traditional system of borrowing and repayment. Any kind of such unexplained amounts will be liable to tax at a massive rate of 60%. 60%. So basically, to target your undisclosed income, massive, huge rate of 60%. Plus there will be compulsory surcharge. Normally surcharge comes only after certain limit, but here there will be compulsory surcharge. HEC always comes, effective rate being 78%. So any assessee having unexplained income, unexplained cash credit, unexplained investment, unexplained money, then 60 plus 25 plus 4 being the net rate of 78%, huge rate of tax will be. And ladies and gentlemen, this is only tax. Interest penalty separate. There is 10% penalty also on this tax. We know this will come in penalties chapter. So this is going to be the applicable rate of tax on unexplained income, investment, cash credit and unexplained expenses. 115BBE. Next, 115BBF, income from patent. Now, which income comes from patent? Obviously, royalty income. This is only for resident. If you remember, non-resident royalty income is already covered. 115A, non-resident royalty FTS 10%, 10%, 10%. But resident has got higher rate. So, for resident also, we will give concessional, but only on patent. So, resident having royalty from trademark, copyright, anything else, brand, franchise, anything, that will be normal rate. Only from patent. If you are the true and first inventor of the patent and your name is included in the patents register under the Patents Act, it will include joint inventor. So, in India, there is a Patents Act under which every time you do a new invention, you register that invention in your name, and if your name is written as the first inventor. And of course, if you are doing it in partnership with someone, then both of you all will be the true and first inventor. So, joint inventors will be covered, but you have to be the true and first inventor as per the patent register maintained under the Patents Act, and this is applicable only on royalty income. So, if I invent something and I allow you to use it, you will pay me royalty. I am the true and first inventor and this is royalty. Then only this 10% will be eligible. Supposingly I sell the patent to you, then my income will be capital gain. This section is not applicable. Okay. Now you are the owner of the patent because you have purchased it from me. You give it to people to use and you earn royalty. That's royalty, but you are not the true inventor. So you will not be eligible. So section is applicable only on royalty income, not on sale, not on capital gains. Section is applicable only on the first owner, true and first inventor as per Patents Act. Subsequent owners are not going to be eligible, and 10% is going to be the rate of tax on royalty income earned from patent. But one thing which is very peculiar and specific about this section, different from the other sections, very specific only to this section, that this provision is optional. That means all other sections were compulsory. You have to take it, whether casual winnings or non-resident foreign national sportsmen, any section. All the sections of this chapter are compulsory, 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 compulsory. All the sections of this chapter are going to be compulsory, right? But this section is optional. That means if you don't want 115BBF, you can go to normal rates. But if you opt for this section, then it will be applicable for minimum 5 more years. So you opt in 1 year, it will apply for 5 more years. 1 plus 5, total 6. 1 plus 5, total 6. If you take it in 1 year, you have to minimum take it for 5 years. Take it in 1 year, minimum take it for 5 years. And in between, if you opt out, in between, if you leave it, then this option will not be available for next 5 years. In other words, once you take it, you have to take it for 5 more years. Once you take it, you have to take it for 5 more years. But once you opt out, then it will not be available for the next 5 years. If you take it once, it will be available for 5 more years. But if you don't take it, then it will not be available for next 5 years. Take it once and available for 5 more years. Don't take it and it will not be available for next 5 years from the year in which you opt out. Okay. Same rule is applicable for 44AD presumptive taxation also. Next, and the last section, section 115BBG, income from transfer of carbon credits. All assessees tax at 10% will be levied. What is carbon? What is carbon credit? Whenever you adopt environment friendly measures, then government will give you carbon credits which you can sell. They are saleable credits. So anybody can buy those carbon credits from you. Any company which is releasing pollutants in the environment will require those carbon credits to save penalty. So I am not going into the detailed explanation of carbon credits. I am just roughly telling you that if you adopt environmental friendly measures, then you will be given carbon credits which are tradable, saleable, and sale of carbon credit income will be taxable at a rate of 10%. That's the section 115 BBG, last section of special rates of tax chapter. Moving on. Let's continue. We have a couple of very small chapters and we have time. So we will complete at least that much. We will try to keep as close as 2 hours every day. And in case we finish a chapter and we are left with only 10-15 minutes, that's a different thing. But we will not stop here. At least 2 more chapters we will be able to do. Remember, this is revision lecture. I don't want any confusion. Don't expect a detailed explanation. Here 200 hours direct tax is getting done in about 15 hours. 10 to 15 to 20, anything in between, 15 to 20 hours we are doing it. Okay, so do not expect detailed explanation. And if by this much also you are understanding everything only by watching revision lecture, sir, I am understanding everything. That's good, but let me be clear, that's not enough. So kal ki date pe when result comes out and then you say, sir, I saw the revision lecture but I did not clear, you cannot blame me because only revision lecture is only revision. You have to study, then you revise. So you cannot directly do. There are people who, I already said this in the introduction class first episode, I don't want to repeat this. This is only revision. Okay. Without knowing the provisions in detail, there is no sense of revision. Only by doing revision, you think then there was no point in writing 4 books. So stop putting the blame on anyone else. Okay. Next, taxation on buyback. Whenever a company is doing buyback, for example, recently TCS has announced, TCS does buyback regularly. When a company pays you dividend, it is like regular profit. But when a company does buyback, basically company is cancelling a part of share capital to you, because if there is issued share capital, then again and again we have to pay dividend and bonus to all of them. So we want to cancel a portion of our capital, and that is called buyback shares. It has distributable surplus, company will do dividend or buyback. What is the system in buyback tax? Whenever a domestic company, what is a domestic company? It is different from Indian company. Domestic and Indian are not same. Indian company means a company registered in India will be domestic company. That means all Indian companies are domestic company. But a company which is registered outside India, that means we are talking about a foreign company registered outside India, but it makes arrangement of distribution of dividend out of its taxable income in India. A company registered outside India which makes arrangement of distribution of dividend out of its taxable income in India, that will also be a domestic company. That means, listen to the sentence, all Indian companies are domestic companies, but all domestic companies are not Indian companies. Foreign company can also become domestic if it makes arrangement for distribution of dividend in India. And we are here talking about domestic companies. Every domestic company, when it does buyback of its shares, whether the shares are listed or unlisted, whenever a company is doing buyback of its shares, listed or unlisted, whenever a company is doing buyback of its shares, whether the shares are listed or unlisted, the company will have to pay buyback tax at this rate. 20% is basic, compulsory surcharge 12%. Unlike income tax where surcharge comes only after income crosses a certain limit. If you remember, in the last chapter itself, we saw unexplained cash credit, compulsory surcharge of 25%. If you still want me to remind you, a cooperative society new regime 115 BAD, if you remember, there was compulsory surcharge of 10%. Here also compulsory surcharge of 4%, and cess, as we are aware, is always compulsory. So this is going to come always. Basic 20, surcharge 12, and HEC 4%, making the effective rate of 23.296% every time a company is doing buyback. A company means which company? Domestic company. Only domestic. Domestic will cover Indian and foreign if it is distributing dividend in India. Every domestic company, if it is doing buyback, whether listed or unlisted, please understand, shareholders will have capital gain. How? Shareholders invested in the shares, and now in buyback they are getting money. So buyback price minus the investment is their gain. Buyback price minus investment is their gain. But the income tax department does not want to run behind individual shareholder for recovery of taxes. So what we will do is, we will make the company pay tax on behalf of the shareholder. So dear company, kindly calculate the gain of the shareholder. How will you calculate? Buyback price is basically for the shareholder selling price, because the shareholder is surrendering shares at this price, minus cost of acquisition of the shareholder. If he had purchased, then his purchase price. If he got bonus, then 0. Rights, then whatever he paid to the company. It can be cost to the previous owner. Whatever was the cost of acquisition as per capital gain provision. Buyback price is the selling price of the shareholder minus purchase price of the shareholder. That will give you gain. You multiply by number of shares bought back. That will be total capital gain of the shareholder, and on this total capital gain, company has to pay this tax. And obviously, this means that on behalf of the shareholder, the company is paying tax on capital gain. On behalf of the shareholder, the company is paying tax on capital gain, and because the company has paid tax on the capital gain, obviously shareholder will get exemption, that we will discuss. But the duty of buyback tax is on the company. Every domestic company, when it does buyback of listed or unlisted shares, then on the capital gain of the shareholder, buyback price minus acquisition cost into number of shares bought back, not the total issued, because all shares are not back, bought back, into number of shares bought back at 20%, compulsory surcharge 12, compulsory cess 4, that tax will be paid by company. And if the company has paid this tax, then for the shareholder it is going to be exempt. Payment of buyback tax is a responsibility of the principal officer, because obviously company is artificial person. It has to be within 14 days of payment of any consideration you have to pay, and if you do not deposit within the time limit, then simple interest at 1% per month or part of a month will be applicable. Part of a month means if you pay on the 15th day, you are late by only 1 day, but 1 day will be counted as 1 month. Delay of 1 day will be 1 month. Delay of 1 day and 1 month, 1 month and 1 day, 2 months, 3 months and 1 day, 4 months. 1 day will be taken as full month, upper round off to the number of months. So if you don't deposit within the time, 1% per month or part of a month, interest will get attracted, and if it is total failure, then the company plus principal officer will be treated as assessee in default. Once you are an assessee in default, then recovery proceedings can be initiated against you. So if you pay late, there will be interest, but if there is complete failure, then you will be treated as assessee in default. Points to be noted: even if the company's income is exempt, buyback tax is payable. Supposingly, company is a agriculture business company, so income tax is not applicable, but buyback tax is not being paid on the income, it is being paid on the capital gain of shareholder. That will be taxable, and the company will have to pay buyback tax. Buyback tax is compulsory even if income tax is exempt. Any buyback tax is a direct tax, and because it is direct tax, we all know for direct tax there will be no deduction or no tax credit to the company or the shareholder. There will be absolutely no tax benefit available, and obviously capital gain will be exempt for the shareholders if buyback tax has been paid. Company pays tax, shareholder exempt. Company pays tax, shareholder it is going to be exempt. So if the company has paid buyback tax, then for the shareholder it is going to be exempt. That was our chapter buyback tax. Moving on, next, special provisions for tax concession in special economic zone. 10AA is the section for getting this deduction. It is not an exemption, it is a deduction, and we are aware that it is a 15-year tax holiday divided in 3 slots of 5 years each. Year 1 to 5 maximum benefit, year 6 to 10 second, and year 11 to 15 lowest benefit. But what are the conditions? One by one. All assessees will be eligible if they are doing export of any articles or providing any service from SEZ, then you will be eligible for the deduction. Now we are learning the conditions, we will go to the quantum of deduction also. We will see all conditions and the quantum. What are the conditions to claim the exemption? First, you should start your SEZ business. Commencement has to be between this period. Previous year 5-6 to previous year 1920. Previous year 5-6 to previous year 1920, can I say same as AY 6-7 to AY 2021? Plus, sir, we are giving exam in previous year 21-22. So, is it applicable to us? Yes. This is the condition to commence your business. If you commence your business in this period, then you are eligible. So, it is possible that you started business in 16, 17, 17, 18, 18, 19 up to 1920. You are going to be eligible for 15 years. The rule is to commence in this period. Once you commence in this period, your 15-year tax benefit will be available. You should not start your business by splitting up or reconstruction of an existing business. So, if you do any business purchase, any amalgamation, any demerger, such businesses will not be eligible. Supposingly, I am already doing business in non-SEZ. and suddenly government announces SEZ deduction. So I close that business and start that in SEZ. Same business I am starting. I close my one office, open another office. Then that means you are only shifting your existing business. That will not be allowed. It has to be a new business activity. If there is any previously used, that means second hand plant and machinery. This condition comes into a lot of places. It comes in SEZ, it comes in 35 AD, it comes at a lot of places. Second hand plant and machinery. If you purchase from outside India, it will be treated as new plant and machinery. That means outside India, imported second hand will be allowed. But if it is domestic second hand, it should not be more than 20% of the total plant and machinery in the business. In other words, new local full allowed, no restriction. New imported full allowed, no restriction. Second hand imported allowed, treated as new, no restriction. Second hand local should be maximum 20%. I'll explain with the help of two examples, and these examples will be useful in the other chapters also. Wherever this condition comes, these two conditions come lot of places. They come here, they come in 115 BAB, they come in 35 AD. So you have to use them again and again. New local 10 and 10, no restriction, fully allowed. Second hand imported 5 and 3, no restriction, fully allowed. Second hand imported is going to be treated as new only, treated as new only. Second hand local is having restriction. Second hand local. Say we have taken an example 3 and 5, 3 and 5. So total becomes 18. Check 20%. 20% of 18 is 3.6. This is within the limit, so allowed. This is beyond the limit, so not allowed. Your second hand local should be within the limit of 20%. If you fulfill the condition, then only you will be eligible. Quantum of deduction. So there are more conditions, but then once you fulfill these basic conditions, what is the quantum of deduction? Your quantum of deduction will be calculated in two steps. Step 1 will not be directly deduction. Step 1 will be to calculate something called your qualifying amount. What will we do in our first step? Calculate our qualifying amount. Calculate our qualifying amount. Profit of the SEZ unit into export turnover upon total turnover. That means our profit in proportion of export. Example, supposingly our profit is 10 crore rupees. We have got 80 crore export, 100 crore total. That means you can say 20 crore is domestic. 10 crore profit from total turnover of 100 crore. In that total turnover of 100 crore, 80 was export. We are an 80% export company. You can say 20 crore was domestic, but that domestic turnover is not eligible in the qualifying amount. So we have to split our profit in the proportion of export. Profit into export turnover upon total turnover. Profit into export turnover upon total turnover will give us what? Not our deduction. Profit into export upon total will not give us the deduction. It will give us the qualifying amount. It will give us the qualifying amount. And then once we get the qualifying amount, what is our deduction? First 5 years of your business. Year 1 to 5, 100% of your qualifying amount. No headache. Full 100% of your qualifying. Next 5 years, year 6 to 10, exact 50% of your qualifying amount. So first step is always qualifying amount. Profit into export upon total. Profit into export upon total. Profit into export upon total. Once that is done, then first 5 years, 100% of qualifying amount. Next 5 years, 50% of qualifying amount, and the last 5 years, year 11 to 15, we will give you deduction, but it's a very restricted deduction. We give you 50% of qualifying amount. That way, the calculation is same as this. Profit into export upon total, that's qualifying amount, and apply 50%. But it will be restricted to the amount deposited in SEZ reinvestment reserve. So you have to pass a journal entry, P&L account debit to SEZ reinvestment reserve. P&L account debit to SEZ reinvestment reserve. Only if you transfer money from the P&L account to SEZ reinvestment, this benefit will be available. So supposingly 50% of qualifying amount is coming to 4 crore and you deposit in SEZ reinvestment reserve only 3 crore. That means your deduction will be restricted to 3 crore. So step 1 is same, qualifying amount, profit into export upon total. Step 2, if it is year 1 to 5, direct apply full deduction. If year it is 6 to 10, then also direct apply, but half. Year 11 to 15, apply half and then check, has the assessee passed this journal entry? If yes, then only deduction will be available. This 50% amount or the amount transferred to SEZ reinvestment reserve, whichever is lower. 50% of qualifying amount or amount transferred to SEZ reinvestment reserve, whichever is lower. And now, in order to get this deduction, the amount in reinvestment reserve should be used to acquire new plant and machinery within 3 years from the end of the year in which the reserve was created. So if we create the reserve in this year, then from the end of the year, within 3 years, we have to use it for acquiring plant and machinery. We have already spent 10 years in business. That means some of our plant and machinery will become outdated, obsolete. We will have to buy new plant and machinery. From the end of the year, count 3 years. From the end of the year, within 3 years, you have to acquire new plant and machinery. Then only it is going to be eligible. Otherwise, the deduction that you have taken will be reversed. And sir, within that 3 years, what you can do? You can use the money in your business. Whatever you want, you can use the money in your business, but it should not be used for. You cannot distribute dividend with that money. You cannot give money to anyone outside India, and you cannot create any asset outside India. Okay, these 3 things not allowed. Dividend, payment outside India, asset outside India. Dividend, any payment outside India, asset outside India. Other than these 3, you can acquire plant and machinery within 3 years. Till that time, you can use it for your business, and if you don't utilize, then such amount will be chargeable to tax, or if you utilize for any other purpose, then also the amount will be chargeable to tax. So year 11 to 15 ka deduction is a very, very dangerous deduction. First, qualifying amount same as the year 1 to 10. Second step, 50%, same as year 6 to 10. Because year 6 to 10 directly 50 is your deduction. But then after applying this 50%, check P&L to SEZ reinvestment. Whichever is lower, 50% of qualifying amount or amount transferred to SEZ reinvestment, whichever is lower, take your deduction. But that amount in the reserve should be used for buying new plant and machinery within 3 years from the end of the year, and if not used or used for other purpose, then it will be taxable. And during that period of 3 years, sir, what we can do? Do whatever in your business, but you cannot do 3 things: dividend, payment outside India, asset outside India. It is compulsory to get, congratulations, you will get money to sign, compulsory to get report of a chartered accountant on or before the 44 AB due date to check whether the deduction is correct. So what sums you solve, that CA has to certify. Only if the CA has certified, the deduction will be allowed. If there is any SEZ business loss, it will be allowed. This is important. It will be allowed to be carried forward and set off, because 10AA is a deduction, not an exemption. When an income is exempt, then loss benefit is not available. Any loss suffered, you will not get benefit. But SEZ is not an exemption, it is a deduction, and thus if there is a loss, you will be getting the benefit. In order to get the benefit, your return of income has to be filed on time. So belated return, no benefit. You can take, for the same business, you can take SEZ or you can take 35 AD specified business. You can take any one of them. Same business, you cannot take both. Same business, you cannot take both. But don't make the mistake. If you have 2 different businesses, on one you can take SEZ, on other you can take 35 AD. On the same business you cannot take, but the same assessee on different businesses will be eligible. Same business you cannot take, but the same assessee on different business will be eligible. Maximum deduction will be equal to GTI. As I told you, this is a deduction, not an exemption. So deduction will be restricted to GTI. If you are doing any inter-business transfer, say you have one SEZ business, one non-SEZ business, and if there is trading between these 2 businesses, and purposely assessees will manipulate the pricing and show more business profit in SEZ for obvious reasons, because you get tax benefit. Inter-business transfer has to take place at fair market value. Or if I have to tell you, let me tell you this, you know this. If the total transactions exceed 20 crore rupees, then it will become domestic transfer pricing case, specified domestic transfer pricing, and arm's length price provision also will be applicable. So inter-business transfer has to be done at fair market value. Inter-business transfer has to be done at fair market value. That was our chapter number 7, special economic zone. Okay, we have some time. So what we will do is, we will go ahead and go to our next chapter, assessment of business trust. Business trusts are of 2 types. The trust which invest in infrastructure will be called infrastructure investment trust, InvIT, and the trust which invest in real estate will be called REIT. So REIT and InvIT together make business trust. System is, investors invest in REIT or InvIT, then they invest further in the market. So this is the investment cycle. From the market they get income, rent, interest, dividend, and that distributed to the unit holder. So what is the tax treatment when incomes are distributed here? When the incomes are distributed here, when REIT sell this asset, what is the tax treatment of the capital gain? And when the investor sells the units of business trust, then what is the tax treatment? That is basically briefly the tax treatment that we are required to study here. And other than that, just one more meaning that you need to know before you go to tax treatment, that there will be some companies here who will be a special purpose vehicle, SPV. What do you mean by a special purpose vehicle? A company in which the business trust is holding controlling interest. So if the business trust is holding more than 50%, like a holding company subsidiary company relation, can I say that the business trust has got controlling interest? Then who will become SPV? This company will be called SPV. What is SPV? An Indian company in which business trust holds controlling interest. An Indian company in which business trust holds controlling interest. That will be your special purpose vehicle. Okay. So this will help you to learn the tax treatment. Whenever a business trust is getting interest or dividend from SPV. So listen, it is possible that we acquire control, or is it possible that there is some other company in which we have invested only in few shares, few debentures? Possible. That means interest and dividend can be received from SPV or non-SPV, SPV or non-SPV. SPV is if we take control, non-SPV if we don't take control. If it is SPV, then the interest will be exempt for the business trust. And from real estate, this is possible only in case of REIT, because REIT invests in real estate, they will be earning rental income. So that will also be exempt. 3 incomes of a business trust will be exempt. 3 income. This is the tax treatment. Interest from SPV, dividend from SPV, rent. Interest from SPV, dividend from SPV, rent. 3 incomes of a business trust will be exempt. But be clear, if it is non-SPV, that is why you need to know the difference between SPV and non-SPV. If it is non-SPV, then it will be taxable. That means if a business trust is earning interest from SPV, exempt, but non-SPV taxable. Dividend from SPV, exempt, but non-SPV taxable. Rent will be exempt, and all the capital gains on the sale of all the shares, debentures, property, all the capital gains will be taxable. There are only 3 incomes on which the business trust will not pay tax. All other incomes will be taxable. What are the 3 incomes? Interest, SPV, dividend, SPV, and rent. Non-SPV will be taxable. And any income which is distributed by the business trust to the unit holders, obviously interest from SPV will be taxable because business trust has not paid tax. Dividend from SPV will be taxable because business trust has not paid tax, and rent will be taxable because business trust has not paid tax. So in short, these 3 incomes which are exempt for business trust will be taxable for the unit holders, and all other incomes, has the business trust already paid tax? All other incomes including non-SPV interest and dividend, has the business trust already paid tax? Obviously yes, because the only 3 incomes which are exempt are interest and dividend from SPV and rent. On these 3 incomes, who will pay tax? Unit holders. All other incomes, business trust will pay tax. At what rate? At maximum marginal rate. Maximum marginal rate means highest basic, highest surcharge, highest cess. Highest basic, highest surcharge, highest cess will make it 42.744%. So highest basic, highest surcharge, highest cess, 42.744. But if this other income includes any 111A, 112 income, short term capital gain or long term capital gain, then the business trust can take that benefit. Otherwise, all other incomes will be taxable at MMR, and because on all these incomes the business trust has already paid tax, they will be exempt for unit holders. So let's be clear. Divide the total income of business trust into 2 parts. Interest from SPV, dividend from SPV, and rent will be the first part, which will be exempt for business trust, taxable for unit holder. All other incomes taxable for business trust, exempt for unit holders. And at what rate business trust will pay tax? 111A take the benefit, 112 take the benefit, all other incomes will be taxable at maximum marginal rate 42.744. And now let's talk about the 3 incomes which are exempt for business trust, these 3, and thus taxable for unit holder: SPV interest, SPV dividend, and rent. One by one. Okay. For the resident, all the 3 incomes will be taxed at normal rates. Interest, dividend, rent, SPV, interest, dividend, rent, all the 3 will be taxable at normal rate. But for non-resident, interest will be taxable at 5%, dividend will be taxable at 10%. This is 115A. Go check 115A special rates of tax. Interest 5% from business trust. Normally it is 20, but business trust 5. Dividend 10%. Normal dividend is 20, but this is 10, and rent there is no special rate, so it will be normal rate. So what is the income tax rate? These three incomes which are taxable for the unit holder: resident unit holder, normal rates for all incomes; non-resident unit holder, two incomes we have special rate 5% and 10%, and for rent we have normal rate. And what will be the TDS? For resident we have a flat rate of TDS 10%. So whether it is interest, dividend or rent, the business trust will deduct 10, 10, 10, because resident, if there is more TDS, we give him refund, and if there is less TDS, then he can pay self-assessment tax. But for non-resident, the thumb rule, the system in income taxes, tax liability equal to TDS, tax liability equal to TDS, tax liability equal to TDS, and thus we will be deducting TDS at the same rates as tax rate. So interest tax rate 5%, TDS 5%, dividend tax rate 10%, TDS also 10, and rent tax rate applicable, then TDS also applicable. And of course, in TDS we have to always add SC and HEC. TDS always includes SC, HEC. Also, if the payee is non-resident, then TDS has to be for, I have written it already, SC, HEC will be added, because full tax has to be deducted. And this last one line, focus please. Non-SPV dividend business trust has already paid tax. SPV dividend, we have said that it is taxable here. For resident normal, for non-resident 10, normal 10, normal 10. But if the SPV has opted for new regime, then only it will be taxable. In other words, if SPV is in old regime, then unit holder also it will be exempt. Business trust, it is already exempt. Business trust, it is already exempt. For unit holder, it will be taxable, but only if the SPV has opted for the new regime. Any SPV staying in the old regime, then unit holder also exempt. So let's, if you want to divide this into category, see, pay attention. Dividend, you check SPV, non-SPV. Non-SPV, who will pay tax? Business trust, topic is over. Non-SPV will be taxable for business trust, topic is over. For SPV, you go and check, has the SPV opted for the new regime 115BAA, because BAB is for manufacturing companies and this is a real estate company. So then in that case, unit holder will pay tax. But if it is an old regime, then for unit holder also it will be exempt. This is the short summary. SPV dividend is exempt for business trust, and for unit holder it is taxable at the rates that we discussed here. Normal rate for resident and 10% for non-resident, but only if the SPV is in new regime. Any SPV in old regime, then this rate is not going to be applicable. Are we clear? And now let's talk about the capital gain part. Whenever the unit holder will transfer his units, there will be capital gain. First possibility is that I purchase the unit from the market and I sell in the market, that is normal capital gain. But second possibility is I purchase shares in a company, real estate company, and then the business trust acquired the company to make it SPV. So I will have to surrender my shares, and in return I will get units. So I have received units in exchange of shares. I surrender shares to the business trust, and business trust gives me unit. At the time of exchange, same as amalgamation, it is not a taxable transfer. Taxable transfer will arise when these units are sold. So I buy shares, in exchange I get units, no capital gain. But when units are sold, there will be capital gain. If it is long term, then 112A will apply, because three assets: equity shares, units of equity and mutual fund, units of business trust. And if it is short term, then 111A will apply. So 111A, 112A will apply on this capital gain. Okay. And if the units were received in exchange of shares, see, if I buy units in the market and sell units in the market, then actual selling price, actual cost price, actual selling price, actual cost price, that will give me my capital gain. Short term, long term, short term, long term, short term, long term. But if the units were received in exchange of shares, there is no cost of units. So what will be taken as cost? The cost of acquisition for capital gain will be the cost of shares. Same as amalgamation. If I buy shares in old company, then it merges with a new company and I get shares in the new company. At exchange, there is no capital gain. When I sell shares of new company, cost will be the cost of acquisition in the old company. Selling price of new company shares minus cost of acquisition of the old company. So same thing here, selling price of unit minus cost of shares, selling price of unit minus cost of shares, that will be capital gain, and the same rates will apply. But now as per SEBI regulations, the units can also be unlisted. Earlier it was compulsory for the units to be listed, but now the units can also be unlisted. If the units are unlisted, then there will not be STT. And if there is no STT, then 111A, 112A cannot apply. Then normal capital gain provisions will be applicable. So normal capital gain provisions will be applicable in case the units are unlisted, and otherwise 111A, 112A will be applicable. Market units, actual purchase and actual sale, but exchange units, then selling price of units and cost price of shares, that will be your capital gain. And this is the entire tax treatment of the business trust and the unit holders on the revenue income as well as the capital gains that has been stipulated here. It is compulsory for a business trust for filing return of income under 139(4)(a). That was our chapter called business trust. We still have some time because the next two chapters, these two chapters are somewhere, they have something in common. The structure is same, so it is better to do this before we end today's lecture. So it is appropriate that we finish this chapter also, investment funds, then we will call it an end, then we will end it here. Okay, so next chapter is investment funds. Similar concept. Investor will give funds to the fund. Fund will invest in company. It can invest in shares, debentures, anything. From here there will be income from shares, dividend, from debentures, interest. It can be PGBP, and that profit will be distributed to the unit holder. So investor invest in funds, fund will invest in business. From the business we will get profits, and the profit will be distributed. Structure is same. The only difference is in business trust, the investment had to be in real estate and infrastructure. But here it can be any kind of company. It can be a company in schools, opening schools. It can be company of it can be a company which is investing in hospitals. It can be any company. Okay, and the profits will be distributed. What is the tax treatment of investment fund? If there is PGBP, it will be taxable for the investment fund. Only one income will be taxable for investment fund, PGBP. For company or firm, as per Finance Act, what is the applicable rate? And if it is any other case, then maximum marginal rate. And obviously, if the PGBP is already taxed for the investment fund, then it will be exempt for unit holder. Same as last time. 3 incomes were exempt for business trust and taxable for unit holder. Everything else was taxable for business trust and exempt for unit holder. The only difference is here, one income unit holder will get exemption, investment fund will pay tax. That is PGBP. PGBP, who will pay tax? Investment fund. And unit holder, it will be exempt. All other incomes, unit holder will pay tax, investment fund will not pay tax. That's the difference. So who will pay tax on PGBP? Investment fund. Tax on PGBP, investment fund, and unit holder, it will be exempt. All other incomes exempt for unit holder, exempt for investment fund, taxable for unit holder. So all you are required to do is split your income into two parts. PGBP, others, PGBP, others, PGBP, others. PGBP, who will pay tax? Investment fund. Other income, who will pay tax? Unit holders. That's it. And of course, unit holder has to pay tax. That means investment fund will deduct TDS. For resident, it will be 10%, and for non-resident, applicable tax, all inclusive, surcharge and HEC, that has to be the TDS. This is the TDS. The income which is earned by the investment fund will be treated in the same nature and same proportion. And whether it is distributed or not distributed, unit holder has to pay tax. Did we discuss that other income have to be taxed for unit holder? Whether distributed or not distributed, supposingly investment fund has got 1 lakh PGBP, 5 lakh capital gains. 1 lakh will be taxable for the fund, 5 lakh will be taxable for the unit holder, whether distributed or not distributed, Unit holders have to pay tax on 5 lakh. Obviously, full 5 lakh will not be taxable for one unit holder. We will divide 5 lakh in the proportion of holding. Example, there are 5 equal unit holders. Then 1 lakh capital gain will be taxable for all of them, even if we don't distribute this. And that is the meaning of pass through. Whether distributed or not distributed, this is going to be taxable for the unit holder, whether distributed or not distributed. So PGBP will be taxable for the investment fund, other income will be taxable for the unit holder, whether distributed or not distributed. Clear? Now what about losses? Can there be losses also? Business loss, capital loss. Till the previous year 18-19, that is assessment year 19-20, the treatment was different, and with effect from previous year 19-20, that is AY 2021, 2 years ago, the tax treatment changed. What was the old treatment? Losses were not allowed to be passed through. So if there is profit, passed through, except PGBP. Yeah? PGBP with the fund, all other profits, capital gains, IFOS, house property, anything, pass through, pass through, pass through, pass through. Unit holder will pay tax even if not distributed. Unit holder will pay tax even if not distributed. Correct? But losses, no pass through. It will stay with the fund. Stay with the fund. Capital loss, stay with the fund. IFOS loss, stay with the fund. We will carry forward. Who? Fund will carry forward. Next year we got profit. Adjust the brought forward loss. Supposingly year 1, 2 lakh capital loss. No pass through. If it was gain, then pass through. But loss, then no pass through. Year 2, 5 lakh capital gain. Adjust the brought forward loss. 3 lakh is gain. Now pass through. So loss will remain with the fund. Profit will be passed through. Set off carry forward will be done by the fund. Profit will be passed through. But from 1920, they changed the rule. They say first check your current year loss. If there is any current year loss, the loss shall be first set off against incomes earned by the investment fund. Set off will be done by the investment fund. So for this you need to know the set off rules. Which loss can be adjusted against which income. Set off will still be done. So no change. Earlier also losses adjustment was done by fund. Now also set off will be done by the investment fund. After set off we have to carry forward. PGBP will be carried forward by the investment fund. So this no change. Set off earlier also investment fund. Now also investment fund. This no change. Carry forward of losses earlier also investment fund. Now also investment fund. But the other losses, this is where the change took place. Other losses, capital loss, IFOS loss. Who used to carry forward? Fund. But now we will pass through. That means if there is 2 lakh profit, pass through to unit holders. If there is 2 lakh loss, pass through. Of course, first do current year set off. After set off, if you have unabsorbed loss, pass through. That 2 lakh carry forward also will be done by unit holders. So profit also pass through, loss also pass through. That will be carried forward by unit holders, but only if the unit was held for more than 12 months. If the unit holder has held the unit for less than 12 months, then pass through will not be available. Such losses will lapse. If the unit was held for less than 12 months, then there will be no pass through. Such losses will lapse. So this is the new treatment. Current year loss adjustments will be done by the fund. Then if we don't have profits, then we have to carry forward. PGBP will be carried forward by fund only, but other losses give the unit holders in their ratio. They will carry forward, but only if they held the unit for more than 12 months, otherwise lapse. But what about the accumulated losses? Now understand, till this year, losses were being carried forward by the fund. So there were accumulated losses on 31st March 19 which were carried forward by the fund. Who will carry forward them now? The PGBP losses continue to the investment fund. Losses from PGBP carried forward by the investment fund. PGBP losses ka carried forward will be done by the investment fund, but the other losses, because we have now changed the system, pass through, but what you focus here is only for the balance period. For example, capital loss is carried forward for 8 years. Till this date, already 3 years carry forward has expired. So now 5 more years. If the rule did not change, then for the 5 years also fund would have been carrying forward this. But now that the rule has changed, the carry forward will now be done by the unit holders, but only for now the remaining period of 5 years. It will be carried forward for the remaining period of 5 years. So carry forward will now be done by the unit holders, but for the balance period. And just like the business trust, the investment fund also has to mandatorily file its return of income. Return of income filing is going to be compulsory. So with this we finish our chapter number 9 in our episode number 2 of revision cum amendment lectures. Some really important chapters coming up. Bonus clipping is not very important, but partnership, charitable trust, and if we finish that, then most likely it is possible that maybe a little bit of math, because anyways it is big, so one lecture it will not be completed. So partnership, charitable trust will come, minimum alternate tax will come. Episode number 3 is going to be a very, very important episode. Please adjust your timing accordingly, and see you tomorrow for the next lecture. Have a nice day. Have a good night. Thank you very much. Bye bye.